Today, we're going to cover another very interesting topic, how to value a stock. Personally, I like to keep things very simple. So I'm going to give you a very relatable example. Let's pretend you're looking to buy a condo and you think that you are able to rent the condo for $24,000 a year. That means it's a rent of $2,000 a month. Of course, there are costs associated with this: insurance, property taxes, maintenance, etc. Let's say you estimate that those costs are $12,000 a year. So now you're left with a profit per year of $12,000. And my question to you is, how much would you be willing to pay for the condo if you think you're going to make $12,000 a year? If you are willing to pay 10 times your profits, that's $120,000. If you are willing to pay 20 times your profits, that's $240,000. Now, with 10 times earnings, your yield, meaning the interest that you will be making, is 10%. How do I get to that? Well, I'm making $12,000 a year divided by $120,000. That gives me like a yield of 10%. If you're willing to pay $240,000, which is 20 times earnings, guess what? Now your yield drops to 5%. $12,000 a year divided by $240,000. Another way to look at these multiples is, let's not take into account anything complicated for now, like time value and risk. How much time does it take you to recover your money? At 10 times earnings, it's basically going to take you 10 years to get back your money. At 20 times, it's going to take you 20 years. Ladies and gentlemen, this is exactly how stocks are valued. You have to look at the profits, and then you use a certain multiple to value the stock. Now, let's look at another example. Assume now we have two condos. Based on our estimates, they both make $12,000 profits per year. However, there is a big difference. Condo number one is in a very popular neighborhood, a neighborhood with a lot of demand. So we think that the prices of rent will go higher. Condo number two, not so much. The rent will stay the same. Now, would you be willing to pay more for condo number one versus number two? Of course, because there is a higher growth of potential profits in the future versus today. Again, that's exactly how stocks are valued. Bottom line, when you look at the stock, you can't just look at earnings and cash flows 1 year from now or 2 years from now. You have to look at the cash flows all the way into eternity. Thank you so much for your time, and I will see you next time.